Welcome to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
When Mary retired from her job as a nurse, it wasn't that she needed $2 million, $3 million, $5 million to live on in retirement. What she needed was something to replace that paycheck that was going to stop. Income to replace that paycheck, because there's monthly bills. And how is she going to replace that income? I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today, we're talking about 3 income-generating alternatives, things maybe you've never heard about. AAA, it's important to generate real income in retirement, not have to depend upon selling your principal, right?
Yeah, that's the bad news, right? You know, like I always use the analogy of the chicken and the eggs, or you can use the golden goose and laying the golden eggs, right? You kill the golden goose and now you've got a problem. But if you just feed the golden goose, take care of that golden goose and live off those golden eggs, well, that's a nice retirement.
Yeah. And today we're going to talk about 3 different vehicles or alternatives to the market that people can receive passive income. They can receive real income. We're going to cover a more conservative option, one where your principal is protected and you have a contractual guarantee that money is going to come in every single month or every single quarter or every single year, depending. One that's moderate, where it's a mix between a stock or a bond, kind of a hybrid, you could call it. And then something that's a little bit more on the higher end of the yield curve that pays you a whole lot of income.
Nice. Yeah, I'm excited about being able to talk about these things with people today, Daniel, because so many times people think that there's just, all you can put your money in is the bank or bank-like things or into the stock market, but there's a whole universe of options in between those two that people don't often know about. And I'd say there may be 8, 9, 10 different things, but today we're going to talk about 3 of those. So I'm pretty excited about that.
Yeah, three can still be a lot. Three good passive vehicles, right? That pay you. You don't have to lift a finger to earn it, and you don't have to touch a dime of your principal because these things are paying you. It's money coming off of your principal, not taking your principal.
Yeah. And it's so wonderful, right? Because you can just let your money work for you. Instead of your money sitting on the beach sipping pina coladas through various times, like many people who had money from 1966 to 1982, their money didn't work at all. They didn't grow their money at all during that period of time. And if that happens for somebody in retirement now, that's bad news. But if their money is working in a sweatshop, working hard for them, then they can be on the beach sipping pina coladas while their money's working for them, right?
Yeah, AAA. The first one, the conservative one, a lot of people understand how a bank CD works, right? Where you put your money into the bank, they give you a rate of return for a certain period of time, let's say 5 years. It's insured by the FDIC up to $250,000 typically. And you sit back and you collect your interest. A lot of people like these, but what people may not understand is they're giving up return. You just said, you sit on the beach while your money's in this, working for you in the sweatshop, working hard, right? The difficulty is a lot of people go the other way around. They worry about not spending money, or they worry about going to work when they don't need to go to work, or they just don't do things that they want to do, like go to the beach, and their money literally sits on the beach. One of these things we see often is people try to be smart, try to protect their money and live off the principal, and they end up buying CDs.
Right.
And CDs can work. They have their place.
Right.
But you're giving up some of that yield by using a CD versus an insurance company's version of a CD. You want to tell us a little bit more about that first conservative income producing alternative, AAA?
Yeah, this is like Daniel just mentioned. It's called a fixed annuity. He just mentioned that it's the insurance company's version of a bank CD. Now, it's very interesting because today I come across a lot of people that don't even know what CDs are.
Yeah, I guess that's
Especially younger people. But there's
they've
even
been bad for so long, right?
Right, exactly. I know about it, but probably people 5, 10 years younger than me and younger probably don't know that much about CDs, right? Because I remember CDs in the late 70s, early 80s being 10 to 20% for CDs. And it would have been beautiful to get like a 30-year CD at that rate, although people weren't doing it because, it's the old thing when the rates were going up and then they started to come down and people were hoping that they were going to go back up again. Right. And they didn't. But anyway, this is called the fixed annuity. And there's a lot of scuttlebutt around the word annuity and what is an annuity. But basically, in this case, it's the insurance company's version of a bank CD. So you know how long the annuity is for. You know what the interest rate is for because that's fixed. And your principal is fixed, just like a CD. But there's some differences, and we're going to talk about that. But, with that, if you're in our listening audience, a lot of people want to know what annuities are. And so we have a paper that we'd love to give you today. You're listening to Financial Strategies with Daniel Agemy, this father-son team coming to you to be able to help you know what you don't know. Today, we're talking about 3 income-generating alternatives that you may not have been told about or know about. And one of those is a fixed annuity. And we have this paper today that we'd love to put in your hand for free by calling us at 800-725-7616, 800-725-7616 for your copy of Annuities 101. This short document will help you be able to understand annuities a little bit more than what you currently have and be able to expand your knowledge so that you can be able to understand how they work. And they're not for everybody and not in every situation, not to put all your money in, but they are a piece of a portfolio or can be very well effective piece of a portfolio. 800-725-7616 for your free copy of Annuities 101. Daniel, these annuities, the thing that one of the things that makes these annuities so attractive over CD, not just the interest rates being higher than CDs, right? Currently CDs maybe are give or take 4% for anywhere from a 6-month CD to maybe a 5-year CD, where these fixed annuities might pay 5 to 5.5% or something like that. And, the rate is not hugely different, but over time that can mean a difference because one of the things about CDs is they're a short-term vehicle for a short-term problem, right? You need money in 6 months, you need money in a year, put it in a CD, you'll be able to do that, right? And so if you want to fix a long-term solution, a long-term problem, or a long-term solution for a long-term problem, something that's paying a little bit higher rate is definitely much better for the long-term with the compounding aspect.
Yeah, AAA, and compounding really is the eighth wonder of the world, right? I mean, compounding, Einstein said it. It is insane. And so just for a quick experiment here, if you had $300,000 and you had it sitting in a CD at what we think is a good CD rate right now, the 4.2%, that's going to pump out $12,600 a year. So $12,600 a year off of your $300,000 CD, pretty good, right?
Right.
I mean,
right.
There's not any market volatility. You know that 12,600 is coming in. Yeah. Where if you were put it in one of these MYGAs or 5-year fixed annuities, same period, right? You could get 16,500, right? Mm-hmm. Just by going to that 5.5 interest rate. So it doesn't sound like a big jump in rates to go from that CD to the fixed annuity, but you're talking about, almost $4,000 a year more just by jumping up that little yield. And when you talk about your money sitting on the beach sipping pina colada or whatever it likes to drink, right, instead of you, what can people do with an extra $4,000 a year? Or if you compound it, AAA, that's almost $20,000 a year over that 5 years. $20,000. Right. Think about what you guys would do with an extra $20,000 if you didn't take on any more risk. Right? Actually, it's more tax efficient. So it's more tax efficient. So these aren't even apple to apple numbers, because if we started talking about the tax efficiency of having the fixed annuity versus the CD, it's even better. But we're just saying interest rate to interest rate, $20,000 more, 19.5 over 5 years.
Right. And that's not even the compounding on that $19,000 or $20,000, Daniel. That's just what the extra amount is times 5, right? But then you get the compounding on that. So it could be pushing close to $24,000, $25,000 a year. Then if you add the benefit of the tax savings that you're getting, especially if you don't need the money, why pay taxes if you don't need the money? Because in the CD, you're paying taxes every year.
Yeah.
You know, year in, year out, whether you take the money or don't
whether
take
you
it
want it or not.
Right.
Yeah.
And so if you include that, depending on your tax bracket, you know, you could be pushing another $5,000 to $10,000 a year of tax savings. Excuse me. Well, let's say probably more like $10,000 for that 5-year period of time of tax savings, or higher if you're in a higher tax bracket.
Depending on your bracket, yeah.
So, you know, you're pushing maybe $35,000 a year difference. $35,000 over that 5 years difference than a 5-year CD paying just 1.5% less, basically.
Yeah. And so this is one of those vehicles, right? AAA. This one, your principal is protected. So that $300,000, it won't go down. It can't go down. These, I know, probably people listening are probably, annuities are complicated. There's a lot of fees, things like that. And there are some annuities like that, but this fixed annuity is super simple.
Yeah.
There's not fees. I mean, I'm sure you could find one with a fee, but you don't need a fee. Okay. It's super simple. It just works like that CD where you invest for a period of time. Like AAA said earlier, you invest for 5 years. You know that you can get your money back at the end of 5 years. You can typically take some out throughout that period of time. You can take the interest out for sure over that time. And you know exactly how much you're going to have coming in each year. Right. You don't have to do a single bit of work. Right. That's passive income that's coming to you. You can take it, you can reinvest it, or you can give it away. People have different goals for their money. Again, you can take it and spend it. You can reinvest it, save it for later, or you can give it away. But that interest is yours. It's coming in. Now, one other thing with that is the bank is making more money than they're paying you. Who do you want to get that interest, that difference in that? Who do you want to get that extra $20,000 over 5 years? Do you want it? Do you want your family to get it? Or do you want the fat, rich banker to get it? You tell me, folks.
There you go, Daniel. Good stuff. Good stuff. Boy, we could keep going with that, but we need to move forward to listen. If you're listening, just turn in, you're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is 3 income generator alternatives that you probably don't know about or probably haven't been told about. Today we have for you a Social Security benefits checklist. Now, Social Security represents income. I started off this section talking about when somebody retires, they need income to replace the check, to replace income that they are no longer earning. Social Security is one of those pieces, but Social Security is only going to be maybe 40% of the income that you need to live the retirement that most people are looking for. But we have this checklist that will be able to help you make sure that you get the most bang for your buck out of Social Security. It's for free. Call for it now, 800-725-7616 for your free copy of the Social Security checklist to help you maximize your Social Security benefits. 800-725-7616 for your free copy. Call now.
Navigating RMDs just got easier, and we're here to help. Turning 73 soon? It's important to know when to take your first RMD to avoid up to a 25% penalty. Learn how to calculate time and manage your RMDs with expert help. Stay compliant and confident. Call us today for your free guide.
You're locked on to Financial Strategy with Andrew and Daniel Agemy.
Yesterday, I was speaking to some of my clients, I'm going to call them Pete and Wendy, and they were just loving their $3.3 million portfolio, pumping out a ton of income every year. And they are just loving that. I said, hey, you've got all your purpose taken care of here. You got all this income coming in from a variety of different sources. And other than the stock market, did you want to put any money in the stock market at this point? Because we can go for some performance. And they said, I really don't want to. Really fine the way it is. It's growing good the way it is. You gave me a 6% increase to my retirement income this year, Andrew. And so I don't see any need to risk any money. And I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. And today we're talking about 3 income-generating alternatives, things you've probably never heard about. AAA, the first one we went through was the conservative option. And that's a alternative to a bank CD, which in our scenario is paying almost 1% more or paying 1% more than bank CDs, not to mention all the tax benefits and things like that. The next one is one of my favorite ones, AAA. And this one is a hybrid. It works a little bit like a stock, but it's got more guarantees or promises like a bond.
Yeah, and it's called preferred securities, and it's given a preferred rating. As an owner of this, you're given preferred rating so that the dividend is set at issue. And the dividend could be, on average, give or take, right, 6.5%, somewhere in that vicinity. But it's set at issue. And that's why you're calling it a hybrid, because most dividend paying common stocks the dividend started, stopped, increased, decreased every quarter. And so you never know what it's going to be. Now they have a history of what they've done, but with preferreds, what makes them so much better is that at issue, they say, we're going to pay you 6.2%. And that's what they pay. And if they don't pay you, it's like the kiss of death to the company, or it could be. So because this is a debt, you're loaning them money. And just like if you didn't pay your mortgage when you had a mortgage, right, the bank would take your house, they ruin your credit, take your equity, same thing. These companies are concerned about their equity being taken, their company being shut down because them not paying their bills. And so that's why it's a much more contractual aspect of it, more like lending than being a trader, right? Not trading stocks, more like lending money, and it's contractual. So it's a much more consistent approach to investing.
Yeah, AAA, these things are geared towards people who want to receive income. And right now, the average on these preferred stocks is right around 6.97%. 7% in income that people can just sit back and receive passive income. Now, why these are called preferred stocks or preferred securities is because you're preferred above the common stockholders. So if the company has to decide, are we going to pay a dividend to our stockholder or a preferred stockholder, they have to pay it to the preferred stockholder first. So you're first in line compared to the regular investor. And that's another reason why it's a hybrid. And so the company may or may not pay their dividend to the stockholder, but you as the preferred stockholder, you get the dividend.
Right.
There's other features along with these where they're more tax efficient. So typically preferred stocks pay qualified dividends, meaning people could get, depending on their tax bracket, dividends that they pay 0%, 15%, or a maximum of 20% if you're in the highest bracket. So they can be tax advantaged to people as well.
That's especially when it's not in an IRA. They just think of their regular brokerage.
Yeah, it would only be
that kind of
correct.
Thing. Yeah.
In taxable accounts. Correct.
Right.
Correct. And so for someone who says 5.5 is not enough for me, I could take a little more risk, I want a little bit more reward, here's a way where you're actually, when you're taking on a little bit more risk, you're actually getting more return. It can be a little bit more volatile. That means your account could go up and down a little bit more. But your return, you're getting that coupon coming in. As you mentioned, AAA, it's printed right on the stock certificate what that coupon is. So if it's a 6% or it's a 7%, it's printed right on the stock certificate. And so folks have an idea of how much is coming into that portfolio each and every quarter.
Yeah. Yeah. I like knowing what's going to come in, because when you know what's going to come in, you can depend upon that, and you know what you have to spend. You're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is 3 income-generating investments that you may not have been told about before. And we talked first about the fixed annuity, and now we're talking about preferred securities. And to go along with today's show, this may be like turning your whole world upside down, right, in a lot of ways. But so our book today is called Turning Financial Planning Right Side Up. The world thinks of things when it comes to retirement in ways that are different than what actually help people succeed in retirement. We'd like to give you this book, Turning Financial Planning Right Side Up, by our friend Jeff Small, to be able to help you be able to understand and look at things a little bit differently, to give you a leg up on your retirement, to make sure that you are able to have all and more than enough income to live the rest of your life without running out of money. So if you want that book copy, we'd love to give you a free copy to the first 5 callers, first-time callers, at 800-725-7616. 800-725-7616 for your free copy for first 5 first-time callers. Turning Financial Planning Side Up. Call now. Daniel, these preferred securities that we're talking about now on these 3 income generating alternatives, it's one of several, like 6, 7, 8, 9, 10 different kinds of investments that we use alternatively, other than the stock market, to help people be able to get the income that they need, more than enough income to live their retirement in the way they want. If they want to go to Italy, be able to go on those travels, get those trips, and help their grandchildren in college, whatever the case may be. So it's not like we're saying this is the greatest thing on sliced bread for everybody, right? But each one of these things have their own place in individual portfolios. Sometimes we use a combination of all of them. Well, usually we use a combination of all of them plus others to be able to help people to achieve their goals for income that they can't outlive, right?
AAA. Right now, we're going through a few that are really, we think, offering some really great risk return, right? When you invest, you don't want to take on a ton of risk, and you have a lot of downside. You have more downside potential than upside potential. That doesn't make sense. And so we're going through 3 things that pay you, 3 things that generate passive income to folks, that they can do whatever they want with that money. They can reinvest the money, save it, compound it, and grow it. They can spend it. They can give it away. They can do whatever they want with that. But the point is, they don't have to lift a finger to get this income. It's coming into their account. It's coming into their bank account. It's coming into their pocket month after month, quarter after quarter, year after year, depending on the investment vehicle. AAA, when we're talking about these preferred stocks, they are fixed dividends, meaning it doesn't matter if the shares go up or down, right? They typically trade at $25 par, meaning they don't typically veer too much above or below that $25. But it doesn't matter if it goes up or down. You get the same amount of income coming into the portfolio.
Yeah.
That's amazing, because when markets are volatile, you don't want to change your spending habits. You don't want to have to change your lifestyle because the markets aren't cooperating. These types of vehicles give you the ability to still get the same amount of income, whether markets are going up or down or sideways. Your portfolios can go up or down a little bit, but the income, the dividends, they still keep coming in.
Yeah. Yeah. And, the thing I'm so excited about, Daniel, is how you're able to buy them at oftentimes $24 a share.
Yeah.
And get that income, sell them at $26, $27, $28 a share, make that profit, make that capital appreciation on it, and rebuy a different one that instead of paying 5.5% or 6% is paying ideally higher than that. So they pick up appreciation and get more income. So it's really interesting what we can do by trading these things at the right time because we're watching them.
Yeah, AAA. There's a lot of opportunities. That's, again, why we're talking about these preferred stocks, preferred securities right now, is because the average is right around that 7% current yield. 7% Sears money. Again, you take that $300,000, okay? $300,000, that's $21,000 a year in income coming in the account. Now, AAA, there's a magic compounding rule, right? If you can get 7.2% return and you compound that over 10 years, it doubles, meaning that if you reinvested that income at 7.2%, that $21,000 generated in 10 years is going to be $42,000. Now, that's not dependent on the market. The market's cooperate or not. That's just dependent on you getting that 7.2% yield and reinvesting it. So think about how crazy that could be. If you're getting ready, if you're close or looking at retirement and you can get in these types of vehicles that pay right around that 7% in income and you compound that for 10 years, that 21 off of a $300,000 portfolio. And partly why we're using 300,000 is because you wouldn't want to put all your money into just preferred securities, right? But if you had a sleeve of your portfolio that was $300,000 paying $21,000 of income and you compounded that for 10 years, $42,000 of income, passive income.
Yeah. It's a very, very sweet thing. Just real quickly here, I was looking at an account recently of one of our clients that if we put it in terms of $1 million, was like in 6 years ago, it was $2.2 million. And today it's $3.5 million. That's just in 6 years, well on its way to compounding. They haven't been using any of that money, but it's well on its way to compounding within that 10-year period of time like that you were talking about. So pretty exciting. You're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is 3 income generating alternatives that you may or may not know about. And so we love to be able to speak to you further. One of the things that people want to know when they retire is, can I retire? When can I retire? And, you need to know how much are you making? How much income do you need? In order to retire, you need income. And that's what we're talking about today. 3 income generating alternatives that they all work together to create an income for people. But when can you retire? Well, that has a lot of other questions to go with it, I would have, as far as how much you need to retire, when do you want to retire, what you want to do in retirement as well, all these different things. And go along with that, I'd love to be able to have a conversation with you around that. I'm going to call that the RRR conversation, the Retirement Readiness Report conversation, where we can have a conversation and talk about what you need to be able to do, or what you can do, what your options are in doing in regard to being able to have a report that shows you succinctly an analysis of where you stand and where you could stand or where you will stand. Call now, 800-725-7616 for your RRR conversation, Retirement Readiness Report conversation, 800-725-7616. Call now.
Market volatility is one of the biggest threats to your retirement portfolio, but with the right strategies, you can help protect what you've built. First, diversify beyond stocks and bonds. Consider real estate, commodities, or dividend-paying assets. Second, rebalance at least once a year to keep your allocation on track. Third, maintain a cash reserve so you're never forced to sell in a downturn. And think long-term. Volatility is normal. A financial advisor can help you build a plan to weather any storm. Reach out today.
This is Financial Strategies with Andrew and Daniel Agemy.
And we're back. Welcome back to Financial Strategies with Andrew and Daniel Agemy, this father-son team coming to you to be able to help you understand that which you don't know. Today, we're talking about 3 income-generating alternatives. And we started off by talking about the fixed annuities. That's kind of like the insurance company's version of a bank CD that guarantees you your interest rate, the time frame, and your principal. The next, we talked about preferred securities that sits the dividend at issue that you can depend upon and know what you're going to be receiving for income in your retirement. And now we're moving on to the third one. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. And today we're talking about 3 income generating alternatives, things that you may never have heard about, things that pay you. AAA, at the beginning of the show, you had mentioned that your definition of a good retirement would be that your money's working for you and you're sitting on, the retiree is sitting on the beach, sipping pina coladas, taking it easy, while the money's out working hard. And unfortunately, we see a lot of advisors and a lot of retirees who no one has taught them how to do these things, to be able to create real income off of the retirement accounts. These 3 things are things people may have never heard about, and they're things that pay you regardless of what's going on in markets. Regardless if you put in the time, right? They pay you. It's passive income that folks can count on.
And Daniel, one of the questions I get all the time when I'm explaining these things to people is, how come I haven't heard of this stuff before? And the reason that you don't hear about this stuff, folks, in our audience, is because Wall Street doesn't make the money that they want to make and that they're used to making off of these kinds of investments. So they don't tell people about them. And so you don't hear from the talking heads. Wall Street's goal is Wall Street makes money with your money, whether the market goes up, down, or sideways. Their goal is to have as much of your money in the market for as long as possible. So they keep coming up with new ways how to get you to put more money in. And the more money that goes in drives the market up more, and then it's just kind of like a Ponzi scheme from that standpoint until everybody gets nervous and everything falls apart. But these things are time tested. This is the old-fashioned way, right? Way people did things in the 50s, the 60s, and the 70s before the market took off like a rocket in the 80s and 90s and beyond. So this is old school that we have brought back because we believe that this is very key to retirees' retirement. I mean, you may have heard about your grandparents or parents talking about dividend-paying stocks and interest-paying stocks, live off the interest rather than the principal, that kind of thing. And that's what we're talking about today. But today, this next one, Daniel, is these business development corporations. These are a pretty cool thing. And I have a lot of people that will say, oh, I want all my portfolio on that. But that's not what we do.
Yeah, AAA. These are pretty cool. And how they work is in 1980, Congress said that small, medium-sized companies were being underserved. The banks had stopped lending to them. They weren't big enough to issue their own public debt. And so these small to medium-sized U.S. companies, the backbone of America, the job providers of America, right, couldn't get money. And they couldn't get money to expand their companies, to grow their companies, to hire more people, to grow their revenues. And so Congress said, well, we'll allow these business development companies to go into effect. And basically how they work is they don't have to pay taxes on the investment income as long as they pay 90% or more of the income they make out to the stockholders of these companies. So they end up paying a ton of money in dividends. Now, these business development companies pay somewhere around 9 to 11% in dividends. And there's a whole bunch of different business development companies. There's some really bad garbage business development companies that you wouldn't want to touch with a 10-foot pole. And then there's some that are very good. And believe it or not, since 2009, some of these have actually beat the S&P 500 on total return. They've done better performance than the S&P 500 on total return. And again, AAA, you mentioned, why do people never hear about things like this? Well, the preferred stocks, for example, a lot of institutions invest in preferred stocks, but Wall Street doesn't make any money off of a preferred stock. There's no fees. So they're not able to sell these things or push these things, or they don't have a reason to do that because there's no fees, right? And so these things that we're talking about, these are things that typically don't have any fees to the person investing in them. They sit back and they collect income.
Yeah. And so that's what's beautiful, just sitting back, collecting that income. That's segues right into the paper we have for people today, Daniel, called Generating More Dependable Passive Income. If you're in our listening audience and you would like to learn more about what we're talking about and how to be able to get this kind of income other than the banks, other than the stock market, call and ask for this paper. Call for it by name. Passive Income, 800-725-7616, 800-725-7616 for your free copy of Getting More Dependable Passive Income. Love to put that in your hand. You're listening to Financial Strategies. Andrew Daniel Agemy, this father-son team coming to you today talking about the 3 income-generating alternatives that you probably haven't heard about. So we'd love to be able to encourage you and help you, teach you what you don't know. Daniel, there's business development corporations. They have been used by a lot of companies that we are familiar with, right? Big name companies today that when they were smaller, they used these business development corporations to be able to help them to get to where they are today. Is that correct?
Yeah, AAA. There's all different business development companies, and they focus on different things. So one of them has really done historic things and helped a lot of companies get to the phase they are today. Some people may have heard of DocuSign, Pinterest, Facebook, Palantir, companies like this that when they were smaller, they needed money to expand their company. So they went to these business development companies and they got money from the company so that they could grow. And then once they went public and now they're a public company, a lot of times these business development companies have warrants or options in the company, meaning that they get a windfall of stock when the company goes public. Now, these companies, they're not allowed to hold that stock once it goes public because their duty is to generate income for their shareholders. And so when they have to end up liquidating these huge amounts of money because a company that they work with went public, they end up taking that cash, and then what do they have to do? They have to pay it out in a special dividend. And they end up paying that to the account holders, or I'm sorry, the shareholders of that business development company, the retiree who owns that company. They get a special dividend. So not only do they get their normal, let's say 8-9% dividend, maybe they get an additional 2 or 3% on top of that, right? Wow. Bringing it up to somewhere between 9 and 11%, like I said earlier. And that's real money, right? When you're talking 9 to 11% of income coming into the account, some of these things pay monthly, AAA. Some of these things pay quarterly, but it's big income that people can get. Now, the business development companies, they can be a little bit more volatile, and that's why they're paying that bigger income. So as you mentioned earlier, some folks will say, well, I want to put all my money in those companies. And we don't recommend people put all their money in these because it can be a volatile ride. This is the most aggressive of the 3 things we've talked about so far. And hence it paying the biggest yield of that 9 to somewhere around 11%. On the more conservative business development companies, there's ones out there that are paying 20%. We're not going to touch those things. We're not interested in those things because we're total return investors, right? AAA. Yeah. We want to get income first, but we want to protect our principal too. We don't want to just get our principal back in dividends. That doesn't make any sense. We want to protect our principal and we want to get a dividend off of it.
Yeah, exactly. So, there's 50 companies or so that are out there, business development corporations, right? And we only like maybe a dozen or 10 of them, something like that, if my understanding is right. And, and don't try this at home, folks, right? Because this is not a thing where you can go out. I've seen people go out and buy these things because they have pay such a high dividend. And then they get stuck in one way or another. Like Daniel says, maybe they get their money back, but it's only through the dividends. And that's the only way they get it. So then you're not really making any money. You're just getting your money back. So you have to really know what you're doing. You have to do the proper research on this stuff, which our team of investment professionals are able to do that research to be able to understand, is this a good one? Is this not a good one? Is this a good time? Do we buy it now? Do we sell it now? Do we rebuy it now? All these kinds of things to be able to help our clients create a portfolio that gives them more than enough income to be able to last the rest of their life. And these are real numbers. These are real things that we're talking about, Daniel, right? This income of maybe 9 to 11% can be substantial over time. Oh, another thing I want to say to you and our listening audience is, it's not like if you were to come to us and say, hey, I want to put all my money in BDCs, we're not going to do it. We need diversification. Even though we diversify amongst BDCs, you need it with other investments. And today's show, we're talking about 3 different alternatives. And we're not saying put all your money in any one of them, right? But all of them work together along with 6 or 7 other ones to be able to help create a portfolio that's going to be able to weather the storm. If you listen to our podcast or a radio show in the past about building an all-weather SUV retirement vehicle, right? That's what we do. Build this thing that has all the things that no matter what happens, you're going to be able to make it through the storms of life and storms of retirement and that kind of thing. Well, you're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is 3 income-generating alternatives that you may not have been told about. Today, we have a checklist. When we're talking about retirement, we're talking about income. And one of the basic sources of income in retirement is Social Security. And we have the Social Security benefits checklist because there's things you can do with Social Security to improve your payout, to improve the money, and it can make a difference of $100,000, if not more, over a person's lifetime, depending on how they choose it. We'd love to put this checklist in your hand to be able to help you make the Social Security decisions. 800-725-7616 for your free copy of the Social Security checklist. 800-725-7616 for your free copy. Call now.
The biggest mistake retirees make is not switching from the growth model to the income model. A good retirement plan is having enough income to last the rest of your life. Any problem in retirement, it can be solved with income. The biggest concern that retirees have is running out of money. The second biggest concern is that they want to grow their money so that they don't run out of money. And they think it's synonymous when it's not necessarily the case. People don't know what they don't know. And they're not going to know unless somebody tells them. People think that the only thing that they can do to grow their money is by investing for growth in the stock market. And it's very much a herd mentality. But you can only get growth when the market goes up. When they invest for income, they're able to get money no matter what happens. I'm Andrew Agemy, founder and CEO of Agemy Financial Strategies. We've been helping people enjoy stress-free retirement for over 30 years.
You're locked on to Financial Strategies with Andrew and Daniel Agemy.
When Pete and Wendy want to retire and stay ahead of inflation, ahead of taxation, that's a big concern. And we have just been talking about business development corporations that might yield as high as 11, 12% for our clients, which is a great way to be able to help stay on top of inflation and top of taxation when it comes to that retirement planning. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today, we're talking about 3 income-generating alternatives, or alternatives to the market. AAA, why are we talking about these 3 things today? They're all in a unique situation. You see, people think rates are going up right now because of inflation. And because of that, these are all paying more than they typically would. The fixed annuities, which we covered first, that are paying somewhere between 5.5%, 5.75%. The rates are that high right now because people think that maybe the Fed is going to hike rates. The preferreds are paying close to 7% right now in income, with potential 20% capital appreciation if rates go down. And then the business development companies are paying so much right now, not because rates may go up, because they actually benefit if rates go up, business development companies, but because they're private credit adjoint, meaning that they're near that whole private credit world right now where people think that it's the same thing. And so because people don't know what's going on with these huge private credit companies and they're trying to get their money out of the private credit companies, they think that these business development companies are the same. And instead of doing the research and finding out, they're selling and asking questions later, meaning that it's provided a really good opportunity in these. And that's why we're talking about all three of these today. Not to mention, a lot of people have never heard of any of these.
And like I said it before, I'll say it again. It's not that any one is the answer to somebody's retirement portfolio. Combining these as well as 6 or 7 other ones create a nice, strong portfolio. But yes, these last ones we were talking about, business development corporations, are quite the thing to add kind of like a turbocharge to somebody's retirement program. But the whole reason why we're talking about all this stuff is create income for people, right? That's how we started the show. That was the story. We started when somebody retires. It's not that you need $1 million, $2 million, $5 million. What you need is income that will last the rest of your life without digging into your principal. And that's what we specialize in. That's why I don't hear from other people, because other people typically aren't specialists in retirement income. They can provide it, but they're not specialists in it.
AAA, these all provide unique opportunities right now, and they're all things that are passive income. They're things that pay you. They're things that pay the people who own them. They're things that pay retirees. Again, it's like, do you want your money sitting, chilling, taking it easy in the bank, or do you want it earning for you? It's going to work. Money's always working for somebody. The question is it working for the banker? Is it working for Wall Street, or is it working for you? Right. And you worked hard for that money. You earned that money. Why not make it work for you? Again, passive income. Folks a lot of times say, well, I don't need income. And maybe you don't, but there's 2 ways to grow your money. There's the way to grow your money through the income, and then there's the capital appreciation. And the difficulty comes when we get to points in the market like we are right now, where market valuations are high on almost every metric you can measure. And in some of the measurements, they're the highest they've ever been, rivaling that 2000 tech bubble.
Yeah, wow.
So the question is, do you want to take some risk off of the table and put it into things where you know the income is coming in, or do you want to keep going the way things are? And that's why we're bringing these up today, AAA, because there is a different way to make money. And when things are high, it usually tends to be better to get your income from that known, or to get your growth from that known, as opposed to the capital appreciation. Take a little bit of the capital appreciation off the table, perhaps, and put it into things that you know will pay you and lower your volatility. And then when that income's coming in, if you don't want to increase your lifestyle, then you have options. You can reinvest it and buy more, which grows your portfolio organically. You can give it away to people you care about, or charities that you really care about it. Or you can just let it compound over time.
Yeah. You're listening to Financial Strategies. Andrew and Daniel Agemy, father-son team, coming to you to help you today. We're talking about 3 income-generating alternatives, and we started by talking about the fixed annuity, moved into preferred securities, finishing up with business development corporations today. These are part of a total retirement portfolio that would include 6 to 7 other income-generating alternatives for people. And to go along with today's show, we have a book that will turn your world upside down. It's called Turning Financial Planning Right Side Up with Jeffrey Small, that wrote this book. He does a great job of explaining things in a way that you can understand, to be able to look at retirement differently, to make sure that you don't run out of money while you're still alive, that you have more than enough money to live the rest of your life the way that you want to live. And you can have that book for the next 5 first-time callers at 800-725-7616, 800-725-7661, Turning Financial Planning Side Up. Call now. Daniel, when we're talking about these things, we're talking about this income, and it's so much different than what the stock market and most professional financial people do, right? Because the S&P 500 dividend is maybe like 1.1%. So that's like on $1 million, we're talking about $11,000 a year of income compared to $60,000 a year from this kind of portfolio that we're talking about. So that's a $49,000 a year difference. That's a huge difference that makes it so much different and so much more distinct when people are talking about planning their retirement and having more than enough income in retirement. Agreed?
Yeah, AAA. It comes down to the purpose, right? If you've got $1 million saved up in your retirement accounts, what is the purpose of that money? Is it the purpose of that money? Is it you're just going to cash it all out and you're going to go buy a boat or a vacation home? Is it you're never going to touch, you saved up all that money and you're never going to touch a dime of that. And you're just going to wait until you die and pass it on to the next generation or a cause you care about? Or did you save up all that money so that you could create an income stream and keep the lifestyle without going to work? And if you want to create that income stream, that's exactly what you're talking about there, AAA. If you have that stock type investment portfolio or money sitting in the bank and you're earning $11,000 to $15,000 off the $1 million of known growth or known income, why not make a few changes and invest in a way that pays you first? You get your known growth, and a mixture of these three things we talked about can get you right around that 6%, as you mentioned. And 6%, that's $60,000 a year of known income on that same $1 million portfolio. So that sounds pretty good to me, right? Instead of getting 11 to 15 of known, why not switch it up and shoot for that 60 of known? Yeah. And then again, if you don't need it, it reinvests and it compounds and it grows organically, right, AAA?
Yeah, beautiful. It's beautiful to know what you don't know. And, if you don't know what kind of income you have coming in, it would be a good thing to be able to understand what kind of income you have coming in. And are you the $11,000 a year coming in, or are you the $50,000, $60,000 coming in a year? We have a retirement risk report that's available that will show you what fees you're paying, what your income is, what your known growth is, what your situation is when you want to retire. If you were in retirement, what it will look like in the future as you go in and through retirement for the decades yet to come in your life. We love to be able to talk to you about that and to be able to present that opportunity to you. It's called the Retirement Risk Report. This is a $3,000 value that you can call to see if you qualify to get this taken care of. If we were going to charge you for the time it takes to do this, we'd have to charge you $3,000. But because of our radio show audience, we're offering this pro bono without charge in regard to that, complimentary. And we love to be able to talk to you to see if you qualify to be able to receive that report. If you're interested in finding out how you can know what you don't know when it comes to retirement, call us now at 800-725-7616. 800-725-7616. Ask for the RRR conversation to see if you qualify for the Retirement Risk Report, a diagnostic that will be able to help you to see retirement before you actually hit retirement. Or if you're in retirement, it will help you to recognize what's going to be happening down the road. Call now, 800-725-7616. You've been listening to Financial Strategies with Andrew and Daniel Agemy. Thank you for joining us this week. Join us at the same time next week, or listen to our podcast anywhere online that you listen to podcasts, Financial Strategies with Andrew and Daniel Agemy, or hit our website, agemy.com, agemy.com. I'd love to be able to speak to you further and teach you and educate you more on those things that you don't know about retirement. So until next week, remember, educated retiree is a happy and stress-free retiree. If you want your retirement to be stress-free, invest more for the I rather than the G.